Welcome to the Money Over 50 podcast, brought to you by Dallas Davison and Michael Hogue from Money Over 50 Financial Advisors. This information is general in nature and does not take into account your objectives, financial situation, or needs. Therefore, you should consider whether the information is appropriate for you and your personal circumstances. If you require personal advice, please contact Money Over 50 Financial Advisors. Here are your hosts, Dallas Davison and Michael Hogue.
Welcome to Money Over 50. Today's topic, the most likely returns of the last 30 years.
Thanks, Dallas. So, episode 138, we spoke about what if I retired and my superannuation dropped by minus 30% just after I retired, which we hear that phrase a lot, Dallas, exactly like that. What if I retire and we get another GFC, or what if I retire and we get another 87 stock market crash?
Yeah.
In that episode, what I actually looked at, or what we looked at, is we looked at the data if you did go in at precisely the worst possible point in time. So just before when the market was at a peak before the 87 stock market crash.
Yeah.
And that's the entry point in, and the exit point out was April 2020, just over a time period of a bit longer than 30 years where the bottoms of the coronavirus were.
Yeah.
So we looked at one set of data there. The second set of data in that episode we looked at was that if I invested just before the global financial crisis, so again at the peaks, and I exited out at the troughs, which was April 2020, what would my returns look like then? Mm-hmm. And in that we presented a set of data that was fairly healthy. Now I'm here to put my hand up and say that the data was incorrect.
Well, I'm glad you say that, because I didn't have anything to do with the data.
Yeah, nothing to do with it. So I'm really, really happy that I was wrong on the downside.
Yeah.
So the figures are actually a lot better than that.
Yeah. And basically, we counted inflation twice.
Counted inflation twice. So on where we referenced the political calculations, S&P 500 at your fingertips, that lookup function website, which we can enter entry points and exit points. Yeah. And if you'd been investing in the largest 500 companies in America, where would you be positioned? Right down the bottom, where it spits out the results.
Yeah.
I was taking that
as the gross
amount, but it's actually the gross return minus inflation. So it's inflationary adjusted. So what I'm talking about there is I quoted a figure that if you'd invested just before the 87 stock market crash, you got a 6.97% rate of return for on average per year. Now that actual rate of return was 9.63%.
Yeah.
Inflation was 2.49%. So they subtracted inflation out of that to give us 6.97%.
Yep.
So
and then we accidentally accounted that 7% as the gross return.
As the gross return, but it was actually the inflationary adjusted return.
Because the thesis, not the thesis, but I guess the point of what we took out of this whole, to summarise the whole 30-minute episode in a couple of sentences, was that, I don't know about you, but I was surprised at how healthy those returns were, given that you'd picked the absolute worst times. You picked the worst time to get in at the sort of the highest price point possible, and then you picked the worst point to stop calculating, which was in the very bottom of the coronavirus sort of panic last year. So over that worst sort of 30-odd year time frame, there was a total return of 9.63%
per annum
as an annualized rate of return.
So you invested at precisely the worst possible time. So again, just imagine you were retiring in 1987.
Yeah.
Your worst fears come true. You retired.
Yeah.
And
big stock market crash.
Big stock market crash. So you retired in October of 87. Later that month, what happened was some fantastic name things like Black Monday.
Yeah, yeah.
I think the total drop was 45% over a 3-day period.
Yeah.
So your worst fears come true. Your superannuation got cut in half, essentially. So if you panicked at that precise point in time, you never recovered from that. Yeah. However, if you just sat there and said,
I'm not doing
Markets
anything.
come back. I'm not doing anything.
Yeah.
The classic plot of the Seinfeld pilot
Do
on
nothing.
Seinfeld.
Do nothing.
The show is about nothing.
Yeah.
So you just do nothing. Sit there.
Yeah.
Be patient.
And by doing nothing,
And by doing nothing, you average a 9.63%. Hang on, let me just check this figure again. I've been known to get it wrong. 9.63% per annum.
Yeah.
By just holding those largest 500 companies.
Yeah.
And you got that year in, year out on average, and we've measured the worst possible point in, and we've measured a really, really bad point out,
So
which is April of 2020, almost at the bottom of the coronavirus
what,
lows.
I guess what we'd say, this podcast is actually about a different sort of topic. So with that, everything that we said in that podcast is still 100% correct. It's just that those figures that we talked about, we said we had around, it was just under a 7% return. It was actually a 9.5% return. So everything that we kind of said in that podcast, if you're listening to this and that's your big fear is, what if I invest and then there's a big drop just before I retire, go back and listen to that podcast. It's all of the concepts remain the same. So that the topic there that we're talking about is the worst case scenario. So you invest at the absolute worst time, and then you have 33 odd years in retirement, and then you pass away at the very bottom of the market 33 years later.
Geez, you're morbid, Blake. Who says anyone has to pass
they
away?
gotta pass away. That's how it works.
Why can't we just pick an entry point and an
Otherwise,
exit point?
there's no natural closure. There's no end to this story. Otherwise, it's just a pot of money that sits
Here
there.
it is. We're recording. You're killing people off.
Well, the point here, I think that's genuinely people's fear, though, is because you think about it. You for most people in Australia, and we've talked about this, your pot of money is for you. Most people just don't want to be a burden on their kids. They're not that worried about leaving a huge amount behind for their kids. They just want to make sure they don't run out of money in retirement. So the big fear is you retire, there's a huge drop. It takes 30 years and things recover, and then you have another big drop throughout there, and that's sort of when you pass away. So that's the natural closure. If we were telling this as a screenplay, this would be what happened.
Okay, I'll let you have that. It's about this. It's about the length of a retirement that we talk about. So from 1987 to 2000 to 2020. That's about the average length of a couple retirement in Australia.
So, if you haven't listened to that episode, I'd highly recommend you go back and listen to it. And wherever you hear us talking about 7% rate of return, what we actually are talking about there is 9.5%. But that's like we say, that's people's big fear. Now, separate to that, this topic is really more around what's most likely to happen. So that's kind of the worst case. What we wanted to do here, and it is your topic, so I'll throw to you, Michael. But what we want to look at is, if you don't pick the actual worst time, if you just go, okay, there's a range of different that I could have invested my retirement savings, and where do I end up, over the next 30 years? So what's most likely to happen, not necessarily the worst case.
Thanks, Dale. So what I looked at as a starting position is what I would consider one of the best times to go in, which was January of 1988.
Yep.
Bearing in mind that we just had the 87 crash occurred in October, November of 1987. So January 1988, generally considered a good time to go in. So if you went in, and again, we're looking at the largest 500 companies in America here, not to suggest you to invest all of your money in the largest 500 companies in America. The data
if you listen to this is not personal advice.
This is completely ease of data. So ease of data. That's not the best companies. It's not the worst companies. It's a broad-based group of companies. We advocate investing, when you do invest in the companies, into a really, really broad base. And the data, it's just ease of data. The data goes back further. So if I go in to those companies in January 1988 and I exit out in January 2021, let's assume I've died. Because you're killing people off.
Well, that's what happens, mate.
What I actually averaged over that period of time is 10.93% per annum on average, so nearly 11% per annum. If I went in a year later, in 1989, January, and exit out at the same period of time, so it's different entry points, same exit out. January 2021 is the exit out. in now on January 2089, 10.72% average rate of return per annum. In on the 1st of January 1990, out in January 2021, 10.34% average rate of return per annum. In on January 1991, out January 2021, 10.73% average rate of return. In January 1992, out January 2021, 10.07% average rate of return. In on January 1993, out in January 2021, 10.15% average rate of return. In January 1994, out January 2021, 10.09% average annual rate of return. And in, finally, January 1995, out January 2021, 10.45% average annual rate of return.
So there's a lot of numbers there, but I guess the point, it's sort of hard looking backwards at those times. And the point we're trying to make here is that a lot of the conversation that we have with people is not so much a lot. I guess there does tend to be, before people come and talk to us, people torture themselves about, is now a good time to invest?
They do.
There is so much time and energy spent on people thinking it's like a skipping rope. The skipping rope's coming, people are ducking, should it jump in? What about now? What about now? What about now? The point of all that is, over such a broad range of time, if you just picked it any time over that 7 years, it basically doesn't matter. The returns over your retirement, as I said, if I've killed you off, from when you retire to when you pass away, your returns were somewhere between 10 and 11%. Not one of those time frames had a return that was higher than 11%, and not one of them had a return that was lower than 10%. So I guess what we're talking about there is, if you look back and you imagine that you were retiring, you were leading up to retirement in the late 80s, early 90s, you imagine the amount of angst that would have gone into thinking, is now a good time? Is a company price is going to drop next year? Are they going to go up? Have they gone up too much already? Should I wait until there's another drop? Should I put some in now, some in later? All that sort of thing. I guess the beauty of it is that when you look backwards and go, that's what happened. That's what the returns were. They were within 1% over that 30-year time frame. It gives, I think, real peace of mind to know that if you're leading up to retirement now and you think this is a major thing that you need to be thinking about, we're here to tell you that you can just forget about it. Just don't worry about it. It really makes minimal difference.
You were spot on. This data proves that. So, two things I'd like to point out. First of all, I've looked at what's regarded here as the best entry period of time, and it actually was. So the best entry period of time out of all of that data was January 1988.
Yeah,
because the average annual rate of return was 10.93% per annum. That's the highest out of the lot.
And the reason that rate of return, just to sort of explain, the reason that rate of return was higher was because the price point that you bought in with was lower.
Well,
we just had the 87 crash. You were buying in at cheaper prices, effectively.
Well, here's what I'd like to point out. So the S&P 500 in January of 1988 was 250 points.
Yeah.
So let's put that into dollar terms. Let's imagine that is dollars. We're paying $250 on average per share in those largest 500 companies.
Yep.
If I'd waited till January 1995, I was actually paying $465 a share. Now, common assumption is that I've missed the boat.
Yeah.
Common assumption is
you'd be gone.
I need to wait for another drop. I need to.
Markets have pretty much doubled over the last 7 years. I've missed that. I should have.
All of those things.
Yep.
All of those things. So if I had paid $465 per share, knowing that I could have got it for $250 per share, some 7 years beforehand, I still averaged 10.45%. As a rate of return. Per annum now.
Yeah. It's not even 0.5%.
It's so close to 10.93%. Now I made more money because if I'd invested earlier, because I got that rate of return. Even though it's only 0.5% extra. I still got 10.93% rate of return. And that's why we say to people, it's the time that you spend in the money in the market. That makes the money for you. The second point that I'd like to point out though is one of the things that we advocate when people ask us all the time, when is a good time to invest? And we say, when you have the money.
Yeah.
So if you've come into a windfall now of $100,000,
Yeah. Just
the time to invest that money is now.
Yes.
Especially considering that term deposit rates are so low at this point in time.
No.
But what most people do, for most people, that's every fortnight.
Yes.
So the money becomes available every fortnight when they get paid.
Yeah.
And if we were to look at the effect of actually, because we've looked at a single entry point in and a single entry point out, what happens in reality is that there's 26 entry points for our clients every year.
Yeah.
Because every fortnight they get paid, they've got money going in. Now, if you looked at that, the dollar cost averaging effect of that, which is buying in at different prices and different starting points, 26 different prices over the course of 12 months. The dollar cost averaging effect of that has it even smooths those returns.
Yeah, it's even less important.
It's even less important.
Yeah, it is. It's sort of interesting to think. I think for most people, it's a relief to hear that because I don't think we're sort of. We've talked about this before. Our financial media all is driven towards short-term things, and what's the market doing this year? What has it done this week? And all those sorts of things. But I don't think that naturally people want to think about that. It's not most people's idea of a good time. If you're a nurse or a school teacher or a builder or a doctor or whatever, you're not sitting there on a Friday going, "Geez, I can't wait to get home and look at all the latest market forecasts and try and pick and choose what's going to happen in the next 6 months." So I think the thing for most people that we talk to is that it's a relief. It's just a relief to know that it doesn't matter. If you get in at a higher price point or a lower price point, yes, lower is better, but it's only better to the tune of a maximum of 1% over the course of that last 30 years. So, and I think the big takeaway for me for this is that if you look at the things that we worry about, most people worry about is that they worry more about investing at the wrong time than they necessarily worry about how much, what percentage of their retirement savings to invest. So if you look at that and you said that, at those times, I'm going to invest, and again, this isn't personal advice, but if you said I'm going to invest 100% of my money in companies, I'm going to invest 100% of my retirement savings in companies, it doesn't matter whether you got the best time to get in or the worst time to get in. You got somewhere between 10 and 11%.
Yep.
Now, if at that point in time you had said, I don't want to do that, I think the market's overheated, or I think that this has happened, or I think that whatever, there would have been 6,000 different reasons at that point in time why you didn't want to invest as much of your retirement savings. If you said, I'm only going to invest half of that money, or 60% or 70% of that money, the amount of money that you left out and that you got cash returns on for the last 30 years, that is a far, far, far bigger drag on your total returns than any issue around what price point did I get in at. Does that sort of make sense? What I'm saying there is that,
look, absolutely. And if you want to go back and look at the data, go back to a podcast called "The Shocking Risk of Term Deposits," which just highlights. Retiring and having all of your money sitting in term deposits and the interest rate that you would have gotten, or having all of your money in productive enterprise, the great companies of the world.
That's exactly right.
And the massive difference to someone's lifestyle over a 30-year retirement.
That's the exact word I'd use, is the risk. Like when you're talking about this with people leading up to their retirement, most people think their biggest risk is investing at the wrong time. And we would say their biggest risk is not investing enough.
Yes.
Not investing enough of their retirement savings in productive enterprise, in companies that are going to get a return of somewhere in that sort of range in future. Now, to clarify even more, we're not saying that over the next 30 years you will get somewhere between 10 and 11% at all. What we're saying is that whatever that long-term average return is, if over the next 30 years companies return an average of 8%, for example, rather than the 10 to 11% here, there might be a period of constrained returns. There's all sorts of things that come into this with inflation, all the rest of it. But if you said over the next 30 years we get an 8% return, the point we're making is that whether you invest at a high point or a low point, you're going to probably get somewhere between 7.5% and 8.5%. So
Yeah.
I don't know whether I'm not saying that figure's 8% either.
Well,
I'm not
let's
saying
cut
it's
that in
10.5.
half. Let's assume it's 4%.
So-
let's say you're retiring right now and
Yeah.
you only get a 4% rate of return
Yep.
by investing in these great companies of Australia and the world.
Yep.
The comparison right now is
Yep.
about 0.5%
Yep.
in terms of term deposits. So you're living
Yeah.
a vastly improved retirement on a 4% average rate of return.
Yeah.
As opposed to a 0.5% average rate of return, which is what the term deposit. So I think your big point there is, Dallas. Also, whatever that rate of return is, we assume it's going to be north of a 0.5% by quite a margin.
Yes. Yep.
And what we're saying is that we know of no one that can afford to retire and have the vast majority of their retirement savings sitting in term deposits and bonds at today's rate of interest, which is about 0.5%.
Yep.
For every $1 million that you have in retirement savings at 0.5%, you're getting your money's making $5,000.
Yep.
Now you're spending
not enough.
multiples of that
Yep.
in the first year of your retirement alone.
Yeah, and that's exactly the point. Is that I think it's easy to look backwards and go, oh well, we got over these timeframes, we got a gross return of somewhere between 10 and 11%. So I don't think returns, and you often hear this, like you read in the news, people go, oh, equity returns are going to be constrained over the next 30 years. Who cares? Like it's still even like you said, even if over the next 30 years you get an 8% rate of return or a 5% rate of return, it's still far better than the other options that are available to you. And that's I guess the big thing is, like, whatever that return is over the next 30 years, it's this is probably a whole other episode about long-term rolling 30-year returns are surprisingly consistent. So there's not.
We have an episode coming up.
I do. Okay,
I've got that on the.
Yeah.
I've got that on the list.
Yeah, perfect. So
gone back 75 years.
Okay, there you go. So my point is that it's you over that sort of time frame. Not only is your return extreme, you basically can't. You can't possibly think that you're not going to get a better than 0.5% rate of return over the next 30 years by investing in companies. Yep. It's just not. It's not rational. It's not logical. And separate to that, if you agree, which, like we just said, if you're retiring now or retiring soon, and you think, well, I can't rely on a 0.5% rate of return. I need to have that money invested in companies. I need to have it working for me. Part two of that people automatically go to then is, well, yeah, but it's now a good time. What about China? What about this? What about that? We're here to tell you that it just doesn't matter. Over the next 30 years, whatever that rate of return is going to be, you are going to practically get around that. You're probably going to get within 1% of that average rate of return, regardless of whether you invest at a high point or at a low point. You're going to get somewhere around what that needs to be. So basically, just accept that. Invest, as we've said, you've got that money to invest for the long term. Invest that money, forget about it, and get back to focusing on what you can control.
And the name of that future podcast will be called Rolling 30-Year Returns, Rolling 30-Year Returns over the last 75 years.
Perfect.
I started in the month that my mother was born. December 1945 was the first
your mother
measuring point.
A lady never reveals her age. She's probably going to be filthy you. No, I think that's I bang on about this because I just feel like it's such.
Yeah, I mean, I have the data. It's remarkably consistent over that period of time. So we won't share that now, of course, but it's remarkably consistent over that period of time.
And those are the things that I think it's if we had unlimited time and energy and attention and focus, then we find all these rates of return really interesting. So we look at it, and that's part of our job with projections and what's you got to look at all these things. But for the person who's looking at getting ready to retire, there's only a few things you need to know. Number one, on average over the next 30 years, companies are going to outperform cash. Number two is that if you assume that, then you're going to have to be predominantly invested in companies. And if you do that, it doesn't matter what price point you get in at. That has a far less impact on you than what you probably think. And thirdly, there are many, many other things that you can do to control how much you retire with in terms of picking up all your tax savings, making sure that you're putting enough away. Taking advantage of this volatility so that you can get money in every fortnight, all these types of things. So it's kind of one of those things where if you listen to this podcast thinking, oh, these guys are going to tell me the most likely returns of the next 30 years and that'll really help me, we're here to tell you that we don't know, and further to that, it just doesn't matter.
Yes, and if we were financial advisors whose value add was to tell people when to invest and to tell them what to invest into, and that was it, then
number one, we'd be crooks if that
crooks,
was us, because no one can do that.
We'd be giving our secret away.
Yeah.
Look, this is just one element of someone's retirement savings. So if you're 10 years out from retirement now, there's so much we can do in terms of picking up those tax dollars that you're not picking up right now by contributing up to your maximum concessional contribution limits each year.
Yeah.
Structuring it so that the day that you retire, you've got all your retirement savings in what's just about to become a tax-free company for you, like a 0% tax superannuation fund. There's just two of the things, two of the main things that we do.
And that's, I guess, my thing is, like, we talk about the returns over the last 30 years and the returns moving forward, is that we never know. Like, if you're 10 years out from retirement, we don't necessarily know exactly how much money you will need in order to live we can do a spreadsheet and it'll show you roughly, here's what you can draw out assuming these rates of return. We don't know what those assumed rates of return are, but we do know roughly the ballpark of where you need to be. And if you're sitting there and what we talk about with our clients in our first meeting is around, how much income you're going to draw every year. We know roughly whether you need $1 million or $2 million or $1.5 million. That's sort of within. So if you need $2 million and you end up in the ballpark of there, and your rates of return are pretty close to what we sort of expect over the next 30 years, you're going to be fine.
Yep.
And that's, like I say, more important than if you need $2 million to retire and you're on track to end up with $1 million. There's a big problem there. It doesn't matter what rates of return you get over that next 30 years. You're not even close to where you need to be. So getting the big picture stuff right is far more important than any time navel gazing, thinking about, on average over the next 30 years, are we going to get an 8% return or a 9% or a 7%? That stuff is all, you want to work that money as hard as possible, but we can't control that. We can only control getting into the ballpark of where we need to be and getting as much money as we possibly can invested in companies that are going to return far better than cash.
And feel free to reach out to us at podcast@mo50.com.au. We'd only be too happy to take a look over your current figures. It's about 1 hour of time that you give up and we give up over a Zoom meeting. And there's no cost nor obligation on your behalf in that meeting. So the source of this data here, if you are interested, is politicalcalculations.blogspot.com, and it's the S&P 500 at your fingertips. Thanks for listening.
Thank you for listening to the Money Over 50 podcast with Money Over 50 Financial Advisors. We look forward to catching up again soon.